What are the tax advantages of a private placement? Before 1986, all the way through 1986, which is when I was a young man and I was in the tax business. And at that time, I actually worked for Price Waterhouse, the giant accounting firm. And one of the last jobs, or the last job that I worked on when I was at the firm, was to convert the books and records of 500 partnerships, real estate partnerships, into tax returns. Dreadful work, but I love reading the partnership agreements. And that's how I ended up in this business. So I've seen a few deals in my career. And at that time, this was a tax-driven business. So in other words, people would buy their share or interest in a real estate deal, or we were doing solar farms like those windmills they have out in the desert in certain cities in America. We were doing the tax returns for all of those kinds of deals. And those were highly tax-driven situations. Well, in 1986, President Reagan changed all those rules under the Tax Reform Act of 1986. And so now our business is not really tax driven. That doesn't mean there aren't tax strategies, but it's not really tax driven. So here's what the main thing what they did. What used to happen was that Dr. Smith would invest 500 grand in a partnership, and that partnership would throw off losses, and they had accelerated depreciation that was much more favorable than the way it works now. And so Dr. Smith would be able to write off hundreds of thousands of dollars. He'd invest 500,000, he'd be able to write off hundreds of thousands of dollars, subtract it from his income, and let's say he made $1 million in salary from his doctor practice or whatever he did. Literally, he would save right off the top, and that person would pay almost no tax because they would write off these real estate investments against their income, their salaries, their dividends, their other investments, whatever things they had, and that's the way it worked. So the government came in and said, listen, it is completely unreasonable to write off real estate losses, which you don't even have anything to do with them. They just lose by themselves, and maybe they're not even losing. Maybe they're just designed to lose, and you offset that against your work. So what the government said is, look, we're going to put buckets together. So we're going to have a passive bucket. We're going to have an active bucket. And you can offset active gains against active losses. You can offset active money against active money. That's it. That's all you can do. So your passive losses and your passive gains have to net against each other. That's all you can do. You can't put your passives and your actives in the same bucket anymore. So that's the way that this game changed as of October of 1986. And that changed everything. It changed the strategy. Now, that doesn't mean that there still aren't some tax strategies. So for example, a lot of people, instead of taking a 39-year depreciation on a commercial property, an apartment building, the real estate part, and remember you can't depreciate the land, what they'll do is they'll hire an engineering firm, and that engineering firm will do a study. Because the logic is, and the Supreme Court validated this some number of years ago, the logic is this: an office building is not only an office building. Some of the office building is actually equipment, which could be depreciated in, let's say, 5 years. So not all of it is real property. Some of it's personal property. For example, the elevator, the doors, certain kinds of moving parts, the air conditioner equipment, the heating, the ducting, some of those kinds of things that need to be replaced more often, that's not considered part of the building. So engineering firms and accounting firms work together to map out these things. And what they'll do is they'll pull some percentage of the building's overall price, and they'll put it into a schedule that says some of it is 39-year property, but a lot of it is 5 or 7 year property. So that's a tax strategy that optimizes the way the tax happens. Another thing that can happen is, let's say that you have a deal that's making cash flow. So you're generating passive activity cash flow. Well, you might look for accountants and you might say to them, listen, we're generating passive activity cash flow. Do you have any clients that have passive activity losses? Because if they could offset their losses against the gains that you produce, then that person might end up netting to zero tax, which is kind of always their goal. They want to net the gains against the losses, and when you do that, then you end up in a really good situation. So you might look for people, if you're generating losses, then look for people that have gains. If you're generating gains, look for people that have losses. And if you tell accountants that this is what you're doing, accountants, they all have pretty good idea of what clients have what problems, and they'll be able to match you with some of their people. So Other than that, there are not a great number of tax benefits left anymore. The general partner used to get certain tax benefits. They don't really get those anymore. That doesn't mean it's not a great business. It's still economically a great business. And there are some limited strategies that you can employ, and maybe an accountant or two will pop up and tell me that there's one or two that I missed. And if so, then we'll make another video at some point in the future. But this is really an economic business, and that's what the government wanted. They wanted it to reflect the economic substance of the transaction. And that's the reason why the promoter should put a little skin in the game. Beside the fact it reflects good, it's something that investors like, it also makes it much more realistic, because the majority of our money, what I call the smart money, comes from the carried interest, which is the part that we earn as a result of our effort, not as a result of our capital. And that's the reason, by the way, that a lot of Democrats want to tax the carried interest as earned income, not as capital gains, because we don't put capital in to generate the capital. We put in services, and then we take it out as capital gains. So some people think that's not fair. And that's really what the issue is when it comes to the carried interest. So kind of a little bit of a tax lesson for you. This is a great business. Now go out and stake your claim.